Hey everybody, welcome to the last lesson. And as you can see, this is our second lesson specifically on equity. And by equity, I mean the equity section of a corporation's balance sheet. So I said this is a big chunk of learning, kind of like capital assets, and it is if you do it in full. But again, we're just focused on the main stuff. And again, and it's that time of year and semester anyway, where you're getting to the end, you don't want to do anything. But if you are planning on going on in accounting or finance or business and you've got accounting on your ticket, first semester, first year course, post secondary, wherever you're going, you probably should at least try this. And if you don't, there's like maybe 5 practice exercises. I mean, if you do them, let me know. I'll share the answers. Or alternatively, there's another exercise you might want to try if you feel like going for the brass ring to see if you can do it all at once with no warm up at all. Without further ado, grab the power slideshow lesson if you want to go through it or just watch the video. I am going to blast through it all at once. So you might want to take a break, have a coffee, come back, finish it off, whatever. And then that's essentially it. We're done. I got a little mastery quiz for you to wrap all the last couple of topics up, and that's it. So without further ado, the slideshow. So this is the equity section after you've figured out all the money you've raised from issuing shares, right? So in other words, what in grade 11 was just called equity or capital, the retained earnings account, and then something called the prior period adjustment, and then all the stuff that comes after, essentially the drawings for a corporation. Dividends, and there's 2 types we talk about. And we also talk about stock splits. So here we go. I'm going to play it. That way we just know that it works. And I've actually been through it first before making the video this time, so I know all of the animated stuff actually works, and some of the slides you actually have to watch animated. So we've talked about this already. I almost always have by the time I get to this point, and if you've taken the finance course, you certainly should know what a dividend is. A dividend is normally, when you say dividend, you mean cash dividend, and it's a payment of cash on a per share basis to the owners, the shareholders. And essentially what it is it's a return of money the corporation doesn't feel it's going to need back to its owners, to shareholders. And remember, we did talk about there's a tax triggered when it leaves the corporate person and comes into the hands of the investor person, a real human. It's taxed in the hands of the corporation and is taxed again. But in Canada, at least, if it's a Canadian corporation dividend, there's actually a tax credit, which evens it out. And it's about, altogether, between the two, it's taxed about the same as your salary. So it's not really any more burdensome than interest or salary. However, there are more than just cash dividends. There's actually stock dividends. And why you would give a stock dividend, there's some it's more optics than anything else. It really doesn't change much, as you'll see. So just be aware that instead of cash, if you don't have any, but people, get warm and fuzzy because you give them a dividend and they want a dividend, then you can give them a stock dividend. But anyway, so moving on. I just said this. Here's some things, particularly if you become an investor and you're a dividend investor and you own companies because you like that income from dividends, you have to be aware of these dates. And I'll just put that out there. I'm not going to spend much time on it. But essentially, the key one is number 3, the Exdividend date. That is the first day on which, if you buy or sell shares in the company, you won't get the next dividend. You miss the date. And the reason is if you say, if I bought shares today, it actually doesn't close. It doesn't legally settle for 3 business days. And so I'm not a shareholder on record for 3 days after I actually buy the stock. The cash doesn't actually come out of my account for 3 days. And that's why there's this delay. So the company will say, we declare a dividend. Anyone who's on record on, say, this date, payable like sometimes months later. But then who's on record this day? Well, you got to buy it 3 days before that. That's all it means. So it really doesn't matter for this course. It's more if you're an investor. Next, to pay a cash dividend, because if you recall, the share capital stuff from issuing shares to finance your company, to raise money, that's legal capital and has to stay in the business. So you can't actually pay a dividend if you don't have profit that you've kept in the business, because you can't pay it out from the money raised by issuing shares. So you have to have what's called retained earnings, which literally is earnings that have been retained in the business, profit that's been retained in the business. Other things you should know, some dividends are cumulative and some are not cumulative. And that means if you miss a dividend this year, then if it's cumulative, it builds up. It just keeps accumulating until you got enough money to pay it. So for example, some preferred shares are cumulative. They also get their dividends, even if they're not, they get their dividends before common shareholders. And if they're cumulative and you haven't paid in 10 years, then they get all 10 years worth of dividends before the common shareholders can ever get paid. So that's something else to be aware of too. Again, not really about our mechanics. Now we're into the mechanics. So here's what a cash dividend would look like. So our example is this company declares a 50-cent dividend, and that means 50 cents per share. Right? So $50,000 total. So there's 100,000 shares. Okay? So it says on record February 1st, the dividend's paid March 1st. So these dates matter for accounting, for bookkeeping, right? So as you can see, the contributed capital, so from issuing all shares, all the excess plus the par value, is 200,000 before the cash dividend. Okay? After the cash dividend, you'll notice it's still 200,000 because you can't pay a dividend out of that money. Out of that wealth. Sorry, it's not necessarily cash, right? Next, retained earnings is 600,000. After you pay your $50,000 dividend, you're down to 550. And so total shareholders' equity goes down. And if it's a big dividend, actually, in the stock market, you'll notice the day of the ex-dividend, the stock price usually falls by roughly the amount of the dividend, right? Because it's trading without that wealth, because that's going to go to previous shareholders, not you. So before it's 800,000, after it's 750, 50,000 less. So shares issued 100 earnings. The book value per share then is $8 versus $7.50 if you have 100,000 shares. And that's the effect on sort of the ratios and values in the company of paying a cash dividend. Make sense? Fairly straightforward. Here's the key for accounting though. Here's the journal entries. So on January 1st, when you declare, was January 1st? Yes, they declare the dividend. So now it's owing. It's an obligation. So you would debit cash dividends, which is an equity account. It's like a drawings. Right? That's the drawings account for a corporation. You credit cash dividends payable, which sounds like a liability. I suppose it is. It is a liability, I think. Some companies classify it as a equity account because you haven't paid it yet. I think it's a liability though. Doesn't matter for us. So on March 1st, when you actually pay the dividend, you debit cash dividends payable. Some people call it cash dividends distributable, but as cash dividends payable, 50,000, you credit cash. Make the payment. Piece of cake. This, notice the date, December 31st. That cash dividends drawings like account is sitting there all year long. It will stay there. You'll make your statements. You'll put that on the statement, just like you used to put drawings on the balance sheet in grade 11, or should have. Right? And it stays there, and that it doesn't get cleared out until the closing entry process. If you remember, closing entries, one of the steps was to clear out the drawings account. Well, same thing. Nothing's changed, except the name of the capital account is called retained earnings, and the name of the drawings account is called dividends. So this last entry is actually in the closing entry. It's one of the closing entries. So we're debiting retained earnings, like capital, and we're crediting the cash dividends to wipe them both out to zero, to reset them for the new year. That's what that last entry is. Make sense? Okay. A stock dividend. A stock dividend is where you issue new shares, which results in you, of course, having now more legal capital, more contributed capital, and more shares. So the effect, what you have to actually do is if hopefully the stock is publicly traded so you can come up with this fair market value. Otherwise you have to guess, right? And that's the value you use for the legal capital, unless there's a par or stated value. And then you've got the legal capital and you have the excess, if you recall from equity part 1. So here's what this looks like. Again, similar scenario. So let's say you issue 10,000 additional shares and the fair market value in total is $90,000 when they're issued. So notice your contributed capital was 200 and now you've issued 10,000 shares with a market value of 90 grand at the time. So now your contributed capital, your legal capital goes up to 290. Your retained earnings goes from 600,000 to 510. It goes down. The rule still applies. You have to pay dividends out of retained earnings. The wealth has to come from retained earnings. So if you don't have cash, you can give a stock dividend. But then that retained earning value has to now move up to legal restricted capital into the contributed capital section. Right? So notice though, equity hasn't changed. 800,000. How could it? Nothing left the business. You didn't bring in more money when you issued the shares, and you didn't pay out a cash dividend. So the total equity, total shareholders' equity has not changed. It does change the optics, the appearance of the business, no, right? Because now instead of 10,000 shares, you have 110,000 shares. And this same company, same year, instead of saying your book value is $8 a share, it's now $7.27. And it would screw up your earnings or profit per share as well. It would muck around with that. So it is what it is. So journal entries here. You would debit again a drawings account, a dividend, but a stock dividend drawings account. And you'd credit stock dividends distributable, not necessarily payable because it's not a liability because you're not going to pay anything to anybody. So this, though, that's where I got confused. This one, stock dividends distributable, is an equity account, not a liability account, right? Because you're going to transfer this capital out of here and into the shares when you issue them on March 1st. That's what this second entry is. The stock dividends distributable, a holding account until the shares are actually issued, is then wiped out, and you put that equity value into new common stock, newly issued common stock. And the last one is, again, same thing, closing entries. Remove it from retained earnings and erase the stock dividends that are sitting there. Note, this one and the cash dividends both. That's when the value leaves retained earnings and goes up into the restricted legal capital section. Right? It happens in two steps. It comes out of retained earnings in these closing entries, and it goes into the contributed capital restricted section up on at the very beginning. On March 1st. So between those two items on those two dates, that's when the value leaves retained earnings and goes up to the restricted section. I know. More than one run through required. So, pause video, rewind. Stock dividends, you can read that as easily as I can say it. Essentially, it's to reward people who feel they always need a dividend, but you got no money. I can't. There's not really a good reason for it. Stock split. Stock splits are when, and companies with large share prices often will do a stock split because they like their shares to be affordable in the general population, right? So like right now, Amazon stock price is like $2,600 for one share. Not too many people can have a portfolio with that in it. And then some people want the opposite. They don't want people trading their stock. They want long-term investors like Warren Buffett and his company Berkshire Hathaway has never had a stock split. One share is like $300,000 for one share. US. It's like $500,000 Canadian. It's ridiculous. If you ever want, you couldn't own it. Although now you can have fractional shares, but anyway. So a stock split is essentially for that purpose, to make it more affordable. To be within the companies believe a certain price range is more advantageous for if they ever need to issue shares, they'll get more buyers. More scalable, more divisible. That's it. It doesn't actually affect the company in any other way whatsoever. So here's a demo. Same numbers. So let's say they have a 2-for-1 stock split. So you still have the same contributed legal capital. You still have the same retained earnings. And you still have the same total equity. All that happens is now, instead of 100,000 shares, you have 200,000 shares. Which means every share after the split has half the claim on the wealth and the assets as it did before. Right? So if you have a $100 share and there's a 2-for-1 stock split, you get 2 shares for every one that you had. And so the stock price will be 50 for each of your 2, adding up to 100 still, and representing the same ownership in the company and the same rights to dividends and all the rest of it as your 1 share before. So it doesn't actually have any effect other than that. You just end up with more shares. That's it. And because it doesn't actually, it's not a transaction, there's no entry. Okay. Nobody's perfect. So there's often times when you go and you publish, like let it out there, all your financial statements, all your work, and you go, oops, big screw up or a big mistake or something comes to light after the fact. That's one reason you need to make a change. And the other is that you change an accounting policy. Because for consistency, the consistency principle, right? You need to keep if you're using units of activity as an amortization method, you have to stick with it. And if you change it, then you have to do a prior period adjustment. So mistakes and changes in policies or principles. And what you do is you don't go back and change previous years. You don't restate them usually. They're done. They're out there. So what you do is you say, hey, we're changing this policy. And you have to calculate, though. So let's go back to the same one. Let's say you did units of activity all the way along, and you decided we're going to use a straight line. You got to go back and find the grand total of the difference doing it both ways. And you have to do the entire difference in a single charge to the retained earnings account. And in the current year, you do it the new way. So there's nothing to change in the current year because you're going to do it the new way. You're going to do it straight line. But all the difference from, hence the name, prior period adjustment, all of that has to be charged to retained earnings all at once. And the way you do it is you change it before you show your effects of this year's activities. So that's what I just said, by the way. I just said that. Let's show you. So contributed capital, $30,000. So from our first lesson on equity, that's everything we learned has just been like common shares, preferred shares, excess, contributed capital. We've just the one line of $30,000, right? So then what comes after is normally retained earnings. You show your profit, you show dividends, your drawings, and then your total shareholders' equity, etc. But if there's a prior period adjustment, before you actually show your retained earnings, you have to show what it was and the adjustment, and then what it is now after the adjustment. So here's an example. This is also all after tax. All the tax effects have to be taken in because it's after the fact. It does have a tax effect, but that effect should have no impact on this year's income statement because it's a change from prior years. This year you're going to do properly or the new way, whatever the reason was for your adjustment. So let's say retained earnings January 1st as previously reported. So this is now the old way or the wrong amount, right? So 30,000, and those two numbers are the same. That's just a coincidence. So what we're going to do is we're going to subtract value because we overstated profit. So we had too much profit, and the reason we said was we recorded too many sales of 4,000 net of tax, right? Sorry, it was less. So it was 10,000 less tax of 4 leaves us with 6. So the next one, we changed an accounting principle on after tax that raised our net worth, raised our profit basically by 15,000 from all previous years. So the grand total of that change, so our initial retained earnings plus the two changes means this year our retained earnings as adjusted the starting retained earnings should be 39,000. And that's how you show it. The rest is as per normal, with the account name slightly different from grade 11, but otherwise kind of the same. So you'd go add profit, and I said it's 150. Then you would subtract any cash dividends, and then you'd show your change in equity for the period of 70,000, which brings you up to 109,000 shareholders' equity. Retained earnings, right? So retained earnings at the end of the year is 109,000, and then total shareholders' equity would be contributed capital from issuing shares plus current value of retained earnings of 109 gives you 139,000. Pause, rewind. If you're good, here's how a stock dividend, if you gave a stock dividend, how it would change this. And if you paid attention, all that's of course going to change is retained earnings going to leave and go up top to the restricted capital, contributed capital section. So if you also gave a $20,000 stock dividend this year for whatever reason, here's what would happen. In the drawing section, right, the dividend section, you would show stock dividends 20,000. That would then reduce your total retained earnings at the end of the year. It would also bring up, notice, right? So it should be, so at the top it's 50 now because that 20 has to go up to legal capital because you issued new shares, right? So 20,000 was the market value at the time. These numbers change at the bottom now. So instead of 70,000 increase in retained earnings, you only have 50. And instead of 109 then for total retained earnings at the end of the year, you got 89. Notice though, at the end, the final shareholders' equity is the same because stock dividends have no effect. You just invent new shares for no extra money. So your total equity, which is this bottom line, total shareholders' equity, is unaffected. Make sense? Okay, this you can read. I don't care if you know it or not. Like I said, if you're going on in this stuff, you might want to try some of these. If you do this last one, though, read the bottom part because the answer key is different than the actual question from the textbook. I've added this part. for you to, a little more rich experience. And the answer key includes this little added part. If you don't feel like doing that many, running out of steam, you might want to go for the brass ring, see if you can do it, and just do the comprehensive one. You'd have to email me, though, to get the answer key, because I've got it buried somewhere. I don't even know where. I'd have to look for it, right? But if you do, it's this one. It's the sort of, it's a Google Doc right here. If you want to do that instead, because if you can do this one, you pretty well get the whole thing, right? And that's it. Congratulations on completing all the key ideas in grade 12 accounting. So good luck. All the best. Sorry this was a crazy semester, and I'll send you a chat when we're done officially. As usual, let me know if you have any questions.